Hi, this will be our last mini lecture for Chapter 5, and we're going to be learning about internal controls involving banks, including performing the bank reconciliation, and we'll also be talking about the reporting of cash. Please get out your Chapter 5 summary notes because we'll be using them today. I will also be using some pages from our text. First, let's talk about the controls that banks provide. Our notes state that banks provide important services to individuals and businesses by accepting deposits, processing payments to others, and providing statements that account for these and other transactions. So these are the three internal control principles or activities that banks provide. First of all, they restrict access. If your money is in a bank, access is obviously restricted to those who are allowed to transact business on behalf of your company. That allows the business to keep less cash on hand and have the majority of their money secured in the bank. The second is documenting procedures. Banks provide a second proof of all transactions that you process with the bank. You would have your records indicating deposits made, EFT payments or receipts or checks written, and the bank would have their record as well. And the third control activity is independently verify. We can compare the bank's records for our checking account with our records and then identify differences in order to check on the accuracy of our cash account. Now let's take a look at cash reporting. This last step, the comparing of the two sets of records, is called reconciling the cash or the checking account. So the process and the related report is called a bank reconciliation. This is a key control because it provides independent verification of all cash transactions the bank has processed for the company. It's an internal report and is prepared by someone other than the person who handles cash and other than the person who handles the record keeping for cash. Okay, so let's take a look at the bank's records, and I'm going to use a page from our textbook. Here we go, and I'm going to make that a little bigger. This is page 228. Now, some of you may receive your statements in the mail, and some of you may just access them through e-banking on your computer. Each month, the bank prepares a report of all the company's account activity. It has the name of the bank, the name of your company, the month of the activity, and then the account number if it's online. But if you receive your statement in the mail, most likely the account number will not be there, just in case your mail falls into someone else's hands. So the bank statement is a chronological list of all the activity in your account for that period. How much money you had at the beginning of the period, how much or all the transactions that you processed, which means any withdrawals or checks that you wrote that the bank received for payment, any deposits that you made, and then some other things that the bank does, like level service charges against you or collects money on your behalf. We'll talk about that in just a moment. Notice that when we have withdrawals decrease your balance, and when you have deposits increase your balance. So we have a running balance from day to day, and then at the very end we have our ending balance for the account, in this case for June 30th. Bear in mind that if you make a deposit late in the day, after 2 or 3 p.m., depending on the bank treats it as being made the next day. The same thing happens if you use a night deposit chute or a digital deposit or ATM late in the day. If this happens at the end of the month, your records could say that you made the deposit at the end of September, but the bank will say that you made it at the beginning of October, for example. Also, the bank statement is prepared from the bank's viewpoint. So for them, our account is a liability. It's our money and not theirs, so they owe us our money. It's considered a liability. When they are increasing our account, they credit our account because that's how you increase liabilities. When they decrease our account, they debit it because that's how you would decrease liabilities. Now, we said that the balance in your cash account may not equal the balance on the bank statement for the same date. Why would that be? Because the company may have recorded things that the bank doesn't know about when the statement is prepared. And the bank may have recorded things that the customer or company may not know about until they receive their statement. I'm going to show you. Let's turn to the next page. There's the definition of bank statement. And here are some things we already talked about. Checks cleared means checks that have been cashed. Deposits made are amounts deposited into the bank. Interest, some checking accounts bear interest, most don't nowadays. And bank fees or charges are what banks charge us to process our transactions. Okay, we covered that. On page 5 in our notes, here's an example of all the differences, things that would cause a difference in your T account balance, your cash account balance versus the bank account balance. But if you don't mind, I'd like to use the page from the book only because it's a little bit more information. In Exhibit 5-8, they show us why, what things that the bank may not know about and things that we may not know about. So what may the bank not know about? Well, errors that they made, or time lags, such as deposits that you recently made or checks that you recently wrote. You would know about them and you would include these things in your T account. However, the bank wouldn't know those things and consequently their balance would be different. Now, what may you not know about? Well, perhaps you may know that your account bears interest, but you might not know the exact amount. Perhaps you may know that your customers may be paying you through electronic funds transfer, or that you may be paying some bills by electronic funds transfer, for example, utilities, but you might not know the exact amount until you receive the statement. You may know that you're going to be charged some service charges, but again, you might not know the amount until you receive the bank statement. Maybe a customer gave you a check which you thought was good, and you thought you were being paid. You deposited it, and the bank thought it was good too, but it turns out that it was not good, that it was a non-sufficient funds check, that your customer did not have enough money in the bank. Well, in that case, the bank would come back and reduce your account by the amount of that check that was not a good deposit. Sometimes you know that ahead of time, they notify you, but you won't see the charge, the extra penalty or service charge on your account until you get the statement. And then finally, you may not know about errors that you made. So the rule for errors, let's go through each of these, is that we correct the error on the side of the reconciliation of the person or organization that made the error. So a bank rarely makes errors, but it does make errors, so it could be that we would have to correct that error on the bank side. Time lags are common. When you make a deposit after the bank's normal business hours, you know you made the deposit, but your bank does not know until it processes the department the next day. And as I said, some banks change their date at 2 or 3 o'clock in the afternoon. And if that happens at the end of the month, they could record the deposit in the next month, and that would be a good reason why your numbers wouldn't match. Time lags involving deposits are called deposits in transit. Now, this refers to only deposits that are made near the end of the month or near the statement date. if you cannot find a deposit that you know you made at the beginning of the month or in the middle of the month, that's a lost deposit. You need to call the bank about that right away. But if that deposit that you made is not on the statement at the end of the month, then it's probably just going to appear at the beginning of the next month's bank statement. So it isn't necessary to call the bank in that case. Another common lag is an outstanding check. This lag occurs when you write a check to a company, but your bank doesn't find out about it until that company deposits the check in its own bank, which then notifies your bank. So if your bank has not yet received notice, they don't realize you wrote a check. Now, in a moment, we're going to be doing the actual bank reconciliation, and we'll find out that things that the bank does not know about, we're going to put on the bank side of the reconciliation. These next items, 3 through 7, are things that we don't know about, things we talked about here. So we're going to be putting those on the books, the company's books side of the reconciliation. And again, it may be that your checking account receives interest, but you don't know exactly how much until you receive the statement. You may know that your customers are paying you, but you won't know who or how much until you receive the statement to find out how much they paid you through electronic funds transfer. Or you may know that your utilities will be paid automatically through your checking account, but you won't know the amount of the utilities until you receive your bank statement. Again, service charges are charges that the bank levels against your company for processing your transactions. You may know the bank may be doing this, but not know the actual amount until you get your bank statement. And then finally, NSF checks are checks that your customers give you in payment, and you deposited them in the bank, but then your bank tried to collect on them, and that customer did not have enough money in the bank. We call those non-sufficient funds checks. So your bank reduces your account by the amount that was not a legitimate deposit, and then you have to reduce your account as well. Okay, so let's look at the actual reconciliation. The main goal of performing this reconciliation is to come to agreement on exactly how much you have in the bank, and we want these amounts, these up-to-date ending balances, to be the same, to equal. The way we do this is we compare each piece of information that the bank and we have in our records to make sure it's the same, and to find out any differences or missing information. And then if we have any differences or missing information, we put it on the side that's missing the information. And then the two amounts should equal. Okay, so on page 230 of our text, we have our reconciliation filled out, but we also have our T account here. So this would be our cash T account listing all of our transactions. We're going to be performing the reconciliation as of June 30th. So we will take our June 30th ending balance, $11,391.40, and we will put that on our reconciliation. Then we have to find our ending bank balance for the same date, $10,638.40, and that goes on the bank side of the reconciliation. And we can see right now that those amounts do not match. So we have to find what information is not the same. So we will start with our T account, and we will compare all the deposits and then all the checks to make sure that they match. So our T account says we made a deposit on June 6th for $3,000, and there it is on the bank statement. If the amounts match, you could put a check mark if you'd like. to show that they match, or you could just leave them alone and do nothing. But sometimes putting a check mark helps us identify what information doesn't match. Then we have a June 23rd deposit of $500, and it's right there. Then we have a June 30th deposit of $1,800, and we do not see it. It was made so close to the end of the month that the bank is probably calling it a July deposit. So we're going to put that information that the bank is missing on the bank side. That's called a deposit in transit. Now, beginning with the Cash T account, let's compare all the checks. In our Cash T account, we see a check we wrote for $500 on June 4th, and there it was cashed. We see check 101 for $55, and we see that it was cashed. We see check 102 for $100, and we see that it was cashed. So far, everything matches, so we don't have to put anything on the reconciliation form yet. We see check 103 for $145, and we spoke too soon. It's not listed on our bank statement, so we need to list it on the reconciliation. It's another reason why our balances don't match. We have it deducted to arrive at our ending balance on June 30th, but the bank doesn't have that information, so we need to deduct it from the bank side. Now let's see check 104. It's for $56. And let's take a look at our bank statement. Oh, check 104 is $65. So who's correct? We would have to actually look at the actual check. In this example, $65 is the correct amount. It was our company, WMT, that made the error in recording that. So we deducted only $56, and we should have deducted $65. We should have deducted another $9. We didn't deduct enough. So we're going to show this as a deduction on the reconciliation for another $9. Okay, now let's look at our last check. 105 for $815, and we do not see that on our bank statement. So that's another outstanding check. The bank does not have that information, so we put it on the bank side as a deduction, just as we show it as a deduction. Okay, so at this point, everything that was in our T account is either on the bank statement or we put it on the bank side of the reconciliation. Now let's see if there's anything on the bank statement that is not yet on our books. Okay, and at this point, if you put check marks, you just find things that had no check marks on them. Okay, so first of all, we have interest earned, $20. I do not see that in our T account, so we need to add that to our bank reconciliation on the books side, the company's book side, because we do not yet have that listed in our T account. Let's see if there's anything else. Right under interest earned, we have the NSF check deduction. And if you're unsure whether it's a deduction or an add, just look to see what happens to your balance. Is it going up or down? In this case, it's a deduction. And I don't see a deduction on our T account for the NSF check, so we need to show it as a deduction on the company's book side of our reconciliation. The next thing we have here is an electronic funds transfer deposit for $100, and I don't see any deposits in the T account, so we need to add that $100 to the company's books side of the reconciliation because we're missing that information. And then finally we have a service charge of $6. And I do not see that amount deducted from the cash T account. So if it's missing, then we add it to the company's book side as a deduction. So the bottom line is you are comparing every piece of information on both the bank statement and the T account, and if anything is missing, you simply add it to the side of the reconciliation that's missing the information. And then when you add down, the total should equal. We're almost done. The last step is we need to record things in the company's books that they have not yet recorded. And that would be any addition or deduction. And how do we record things in our accounting records? We use journal entries. So we need to do a journal entry for every addition and deduction. Every addition adds to the cash account, and we add to assets like cash by debiting. So we will debit cash for $20 for the interest earned, and we'll credit interest revenue. For the electronic funds transfer payment received from the customer, we want to add to cash, so we debit cash, and we will credit the customer's accounts receivable account. For every deduction, we need to reduce cash, so we will credit cash for each of these. What will we debit? It depends. For the first item, that was the NSF check. When we received the customer's payment, we debited cash when we deposited that check, and we credited the customer's accounts receivable account. So right now, that customer, R. Smith, does not have a balance in his account. But we know now that they really didn't pay us. So we need to restore that customer's accounts receivable. So we will credit to deduct from cash, but we will debit accounts receivable to put that customer's debt back on our books. For the service charge, our textbook likes to use the account office expenses. So we'll credit to reduce cash, and we will debit office expenses. In the real world, I usually create an account called bank service charge expense so companies know how much the service charge is, because it's usually a lot more than $6, usually hundreds of dollars. But we're going to use what our book tells us to because Connect is set up to accept this as a correct answer. Finally, for the company error, that check was in payment of a supplier, and we credited cash and debited accounts payable for $56 instead of $65, so we need to debit accounts payable and credit cash for an additional $9. And that's it for our reconciliation. We would post each of these journal entries to the T account, and after posting, our T account, instead of stating $11,391.40, if we correctly did our journal entries, the ending balance of the T account should equal the reconciliation ending balance or up-to-date balance for cash. Now we're almost done. The last thing I want to mention is on our last page of our notes, the reporting of cash. Now, when we do our balance sheet, we don't report to our stockholders every single checking account and cash account balance separately. We kind of lump them together in a category called cash and cash equivalents. So there might be several checking accounts that add and cash equivalents that add up to this amount. You don't have to separately list every single account. So let's read. Cash as reported on the balance sheet includes cash deposited with banks, petty cash on hand, and cash equivalents. Cash equivalents are short-term, highly liquid, that means easily sold, investments purchased within 3 months of maturity. They're going to turn into cash really quickly. Cash equivalents would include money market funds, government treasury, bills, and other highly liquid investments. So they're lumped together in this one amount and reported on one line in your balance sheet. Restricted cash happens when companies are sometimes legally or contractually required to set aside cash for a specific purpose and not allowed to use it. So we would list that separately on our balance sheet. And that ends our mini lecture for this chapter. What you can do if you'd like is to watch the YouTube video demonstrating a bank reconciliation homework problem. Take care.